I always had this idea that if I messed up, I would have a chance to recover. Uh, and I did mess up, and I did have a chance to recover. And from my point of view now, I would say it would have been far wiser for me to be more risk averse in my investing.
Hi, everyone. This is Jack Allwild with another money episode. Today, we have very special guest David Barnett with his book, Buying versus Starting a Small Business. David, welcome to the show.
Hey, Jack, thanks for inviting me over. It's great to see you today. How are you?
I'm doing great. So, before we get into your book and some of the great concepts you discuss, I do like to ask everyone, what was your relationship with money like growing up?
It's a great question. A lot of the times when you hear a podcast and someone asks that question, you hear that people didn't really know much about money or anything like that. Not me. I was all about money from a very young age. If you remember, I don't know if you there was used to be a show on TV called Family Ties, and there was
Mm.
a character, Alex P. Keaton, that was all about money, and I thought that guy was great. He was kind of like an idol for me. And so I was reading books about investing and money as a child, and I was always kind of dream up these little business schemes as a kid to make money, and always did those, sort of childhood businesses like mowing lawns or shoveling snow for people to try to earn money. In fact, I even became a sales representative for a company that's now closed called Regal. And Regal was a greeting and gift company. And you would buy these catalogs and bring them to your friends and neighbors, and they would pick out things that they wanted to buy, like greeting cards, gift wrap, and other things. And I would submit orders and get a big box with everybody's stuff. And then I would have to divvy it all up and go deliver it. And I would earn a commission on the sales. I mean, I was doing that when I was 12. For my birthday, my dad got me business cards with the family's house phone number on them, for Regal Greetings and Gift Representative. And so I was all about it, and I was very fortunate that I was raised in a household where um, dad had a good job. He was not a business guy, but he was an engineer. And so he had a good income, and he was very fastidious about the budget in the household. And he had an investment advisor that used to come over, and I used to be able to be part of the family meeting when the investment advisor would come over. So I learned as a kid about, mutual funds and things like that. And most importantly, um, I learned through example because we had relatives and people we knew who were really bad with money. And so I would hear little whispers about things that were going on, and then I would have to ask my dad, like, Dad, what is a third mortgage, and why is it so bad that someone we know got one? Right. And just kind of like see other people mismanage things, and the result of that path. And it kind of helped me be a little bit more cautious and aware of some of the bad things that you can do or ways that you can live that can lead to trouble. Yeah, in basically, that whole rule of live within your means. If you're observant enough, you can see examples of how people live beyond their means and how it ends up costing them tremendously in the long run.
Awesome. Yeah, it's always good to hear how, yeah, some people are totally not involved in their parents' finances or in the budgeting discussions, but that's cool that you were so involved. So, getting into your book, Buying versus Starting a Small Business, I think one good thing you mentioned early on are some definitions. And I think an important one is the entrepreneur versus an investor. So,
Yeah.
could you break down those definitions and perhaps can we be both?
Yeah, well, I think you need to be if you're going to be in the world of business, but I draw a distinction because I think of it as an entrepreneur as someone who has a vision. They want to create something and have it come into reality. And so these entrepreneurs are typically the people that start businesses. Now, people who buy businesses definitely have a different mentality. And so what someone who is buying a business is thinking is, how much money do I have to put into this deal, and what am I going to get out of it? It's almost the same kind of mentality you have when you meet with a financial advisor to talk about your retirement planning. If I put some money into this mutual fund, what is it likely to return to me? That kind of thing. Now, I notice that people move back and forth across that line throughout their careers. So lots of entrepreneurs who've started businesses and gone through the struggles and hard work of a startup, maybe working for years with hardly any pay as they try to fix and build and develop a business. They will often, when they decide they want to do something else or they decide they want to grow, will decide, I'm not going to do that again. I'm not going to start another business. I'm going to go buy one. So that's an example of an entrepreneur moving into that investment mentality. And then any business, no matter how big or small it is, needs to be evolving and changing in order to survive. As technology and markets and the demands of customers change, you've got to be adapting. And so that means even if you are an investor that buys an existing business that already has customers and cash flow, you still need to be entrepreneurial in that you have to be examining what's happening and changing in the market, and you have to be tinkering with that business and making sure that it continues to be relevant as it moves on into the future. Otherwise, it ultimately will shrivel and shrink as people move on to other things. All kinds of examples out there of that kind of thing. Sort of the classic buggy whip sort of example.
So you mentioned also that, unsurprisingly, many businesses fail, but you drill down even more that there's a difference between staying open versus actually succeeding at business. So, in your words, what does success in business actually look like?
Yeah, I can tell you read the book. Um, People will talk about small business and the risk of small business, and Americans in particular, for example, will look at SBA default rates, like SBA loan default rates, which are quite low. And they'll say, look, all these people are borrowing money from the SBA for business, and very, very few of these people default on these loans. So therefore, it must be pretty easy to be successful in business. But I call success in business being able to do something in a business every day, pay yourself a fair market wage for what your time is worth, and then have a profit beyond that, which allows you to earn a rate of return on whatever money or time you invested in building or buying the business. And if you hold that as your standard of success, far, far fewer businesses meet that standard. Over the course of my career, I've looked at, like, I don't know, hundreds or maybe even 1,000 different sets of financial statements from different businesses. And most of them, more than half, the owner is working full time in the business, but they probably would earn more if they went and got a job somewhere else, right? So in my mind, that's not success. That is a person contributing their labor to keep something open that might normally be closed. If a stranger owned it and was paying them a fair market wage to run the business for them, the stranger would be losing money, and the business would probably already be closed. So I think that you need, as business owners, to hold yourself to a standard of success, which is going to require you to make sure the business is functioning at that performing level, to pay yourself what you're worth and earn a profit. And I think it's important because people get stuck in that in between place and they don't know what to do, but they're earning enough money to service that loan, right? So they're not defaulting on the SBA loan, for example. They don't quite know what to do to make it work and get ahead, and they just end up stuck. And it's hard to make a decision one way or another. And I think that's a trap that can easily catch people in the world of small business. And I just wanted to make people aware of it. Um, Business owners that you've seen open for years and years and years could be in that trap. They might be stuck in that spot. You never really know what's going on in a business unless you see the financial statements. And depending on how the business is being run, the financials may not be telling an accurate story of what is really going on in the business too.
Mhm. On that line, like, how do you kind of keep in your mind if someone came to you and said, "Well, I value running my own business and maybe only making 60 grand versus making maybe I could make 120 working as an employee, but I value maybe my time or like that freedom more." How do you think through that? Or yeah, what would you say to that person?
Well, I think that it's all a matter of personal choice. And so, what I would ask that person is, I would say, would controlling your time, having time freedom, is that worth $40,000 a year to you? And then it's a completely subjective answer, right? It's
Mhm.
entirely up to the individual to answer that question. In some of the other books that I've written, I actually pose that question. I say, what is a sort of a different lifestyle worth to you? I've had clients who I've helped buy businesses with who have left, C-suite jobs in big cities like Chicago, where they had an hour-long commute and they were working 50 hours a week, and it was very stressful. They were earning a lot of money, but they made the decision to buy a business out in Colorado that earned half as much money and came with an entirely different lifestyle. And they would tell you it was worth it for them to invest $150,000 a year in an income loss in order to completely change the way they live. And maybe it's going to result in a longer, happier life for them. But that's the kind of evaluation people really have to make. And I meet a lot of people who have really great jobs who end up in the sort of gilded cage scenario where um, they earn a lot of money in their job. Maybe they don't like the job, but the opportunities, if they're going to leave that and get into business, may pay much less. Here's what I would have to say is that if you are a programmer for Google or something and they're paying you $300,000 a year, that's the fair market wage for being a programmer at Google. If you want to buy a burger joint and become the owner operator of the hamburger joint, well, what's the fair market value of being a manager of a hamburger joint? Is it 55 grand, right? So if you leave the Google job to buy the hamburger joint, then the question is simply one of happiness and lifestyle. Am I willing to take this pay cut to have this different life? And people who are not getting into business, who are just employees, they face the same kind of question all the time. When someone says, you know what, I'm going to leave the city or I'm going to leave the country to go move over there, and I'm going to earn less money, but it's going to be worth it for me in the long run because of these reasons of things I value. And it's really just a matter of self knowledge and deciding what's important to you.
So I think one thing that might surprise people are the market values of buying an existing business. So you break down the value of a business as a multiple of what you're calling sellers' discretionary earnings. Can you break down what that number is and some of the multiples that are common to see in different industries?
Yeah. So this is part, people might see headlines about why buying a business is such a great opportunity. And they might see something that says that small businesses are often valued between 2 and 3 times their cash flow. And what that headline is talking about is this seller's discretionary earnings. So the definition of SDE is the amount of money available to an owner operator that works full time in a business. So the way we get to this number is we take a P&L statement of a company, and we start with that net income down at the bottom, and then we add back certain things. So we're taking away some of the expenses and piling them up in this SDE number. And these are any money that the owner takes. And the reason we add that back is because the owner doesn't necessarily have to pay themselves a fair market wage. If you own a business like that burger joint I mentioned, where a manager normally earns 55 grand, but you can afford to pay yourself 90 and you do, it's not a problem. Like you just took a salary of 90 because you could afford to. But we want to add that back because that entire 90 is part of the money available to the owner, right? We're also going to add back interest on any debts. And the reason we add back interest is because the way that the current owner finances their business operations is likely going to be different from the way the buyer will. So we're going to add back the interest expense so that it's part of the money available for the buyer to come up with their own financing methodology. We're also going to add back taxes because taxes to a certain degree are discretionary. The way that you manage the business, the choices you make are going to affect how much tax you pay. So, for example, if you bought a piece of equipment, you could elect a bonus depreciation, which reduces your income and changes your taxes, right? So, there are management decisions that can come to play that affect your tax bill. So, we add back the income taxes. Again, the buyer is going to have to consider their own scenario and what their tax bill is going to be. Then we look at depreciation and amortization. This is how accountants demonstrate long-lived assets wearing out. And so you don't pay a bill for your depreciation expense every year. You paid when you bought a piece of equipment, the depreciation happens over many years. So we add back the depreciation because it's cash available to the owner, again, with the caveat that the owner is going to have to make their own consideration about any capital expenditures. So that seller's discretionary earnings, this is the money an owner has discretionary control over. They get to direct how it goes. So to say that a business sells for 2 to 3 times this seller's discretionary earnings is not the same as saying, a publicly traded company sells for 30 times its profit or EBITDA, because that profit at the publicly traded company takes into account capital expenditures, taxes, any interest on financing, all that other stuff. And over at the publicly traded company, when you make the investment, the leadership team is intact. The president, all the managers, all those people are over there. In the small business acquisition, the brain trust of leadership that the current owner has, when you buy the business, that person's going to leave. You have to do their job now. So, and that seller's discretionary earnings is a mixture of profit and your salary. So it's not the same as just like a profit of Coca-Cola or something like that.
Mhm.
So the multiplier number looks different, but it's an apples and oranges comparison if you want to compare it to a stock. Okay. Most of the time, when you pay 2.5 times seller's discretionary earnings, you might still finance a large part of that purchase price over 10 years. And you need to afford it, because out of that seller's discretionary earnings, you got to take 5 things. Number one, you got to take home a salary to live on because you're going to work in the business. That's what SDE assumes. Number two, you're going to pay debt service. So that's the payment on the loan you take to buy the business. Number three, you got to pay taxes. So if the business is profitable, you're going to have a tax bill, right? And if you take home a salary, you might imply that, part of that salary will go to taxes, but the business is going to have an income beyond that that's going to be taxable as well. So you have to have money available for that. You need to get a return on the cash that you put in. So if you buy a business for $1 million, even if you finance 90% of it with a loan, if you put in 100 grand of your own money, you need to get some kind of rate of return on that money, right? That's got to come out of SDE. And lastly, capital expenditures. So, like I said, depreciation and amortization have been added back. So, if there's any new piece of equipment that needs to be acquired in the years after the acquisition, it's going to come out of the SDE. How that happens is going to be up to you. Again, it's your discretion. Are you going to save up cash to buy a new truck, or are you going to lease one? Right? You can do whatever you want, but these are all going to impact ultimately the amount of money that ends up in your pocket after everything is said and done. Where a lot of buyers get into trouble, Jack, is that they'll see that seller's discretionary earnings number, SDE 200 grand, and they'll think, man, if I put 500 grand into buying this business, I'm going to earn 200 grand a year. And that's not true. They're not going to earn 200 grand a year because of all those different things that I listed out that comes out of that 200 grand.
Yeah. So, but yeah, I mean, you make the point in the book, because of different debt, different salary, you could be buying a dramatically different company than the one you think, or you see that the former owner is operating.
Yeah, because if the current owner of the business has a long time profitable business, they've probably paid off their debts, so they're enjoying a really fantastic cash flow as the owner, um, and they often don't empathize with the buyer. They don't see your point of view because you know they don't have this big debt service. And oftentimes in a negotiation between a buyer and seller, it can be very helpful for a buyer to show the seller what the true cash flow scenario is going to be for the buyer, to show them, hey, like if I do this deal and I borrow all this money, here's what my situation is going to be. It's going to be very different from what yours is. Most sellers don't appreciate that because they're often in a really great position, especially if they've paid off their debts.
Yeah. So some of the listeners might be liking what you're saying. They might be interested in buying an existing business, but you also go through maybe some questions that we should be asking ourselves if we maybe just wanted to start one. So I think you brought up an example of a lawn care company asking like a certain multiple, and then breaking down the alternative. Can you go through some of the questions we should be asking ourselves if we're trying to determine whether we should start or buy?
Yeah. So one of the ideas I explore at length in the book is whether you're going to start a business or buy a business, you should always compare the other plan in your thoughts and in your understanding. So, for example, um, people will think that buying a business is less risky because you already have customers and profits, right? When you start a business, you don't have any customers and you have to build that clientele to hit your break even point. And people say, wow, what if it takes me a long time to reach my break even point? What if it takes a long time to find these customers? So that looks risky, and it is. If you pay too much for a business and you have a huge debt service payment, you now have customers, but if you lost 5 or 10% of them, maybe now you can't make your debt payment. You're literally in the same scenario. You are in the same situation with respect to the risk of customer retention or acquisition. But furthermore, not only are you risking the money you put into the deal, but you also have this big debt that you probably personally guaranteed, right? And so if the price of the business is too high and there's too much of what is called finance risk, then you compare it with doing a startup. So I gave an example of a lawn care business, a lawn mowing business, and I said, if the guy wanted 3 times this SDE, what would it cost you to just hire some employees, pay them for a year, and do you think that in a year you could find enough new customers to reach a break even point? And I think that the solution, the result of that question was like for a third of the price, you could probably pull it off. So then you have to ask yourself, is it is it worth it to pay that extremely high price to achieve what I probably could achieve for a third of the cost if I worked at this for a year, right? And so it's always that balance because what will happen is people will get enamored with a concept or they'll go look at a business that they found listed online. They'll meet the seller. They'll start daydreaming about what it's like going to be like to run that business, and they'll think about the changes they want to make. They actually become emotionally invested in the business. Good friend of mine named Ted Leverett coined a term called buyer fever. He said this is like buyer fever. Like you get so excited about the business that you lose sight of other opportunities, you lose sight of the objective questions in analyzing it, and you become focused on how do I get the business, how do I do the deal. The reality is that you should also be focused on what I call the day two problem, which is the day after you do the deal. How are you going to successfully run it and service the debt and take care of everything you need to? And so often people they focus on buying the business and doing the deal versus the day two problem. You need to step back, look at both the acquisition and what the cash flow and operations are going to be like once you do the deal, and then sit down and say, if I built it from scratch, what would it reasonably cost me? What would the worst case scenario be? And if that is substantially less than the asking price of the business, does it really make sense to do the deal? Or should I, you know, take what many would say appears to be the higher risk of doing the startup, but the investment is so much smaller. When you do a startup, you put money into it, you could lose that money if it fails. Like I said, when you buy a business, you also put money in, maybe less money, but that debt often has to be personally guaranteed. And that can become a huge burden if the business doesn't work out, ultimately leading to losing other assets you have or bankruptcy or whatever.
So this is a topic we discuss on this channel a lot, and it's hurdle rate. And you mentioned it in the beginning of the book. And I think a lot of people are starting to question what they should be seeking for returns when they see their governments printing a lot of money and things like that. So how do you think about a hurdle rate?
Um, so with respect to like runway, like how much money you need to get by.
Or just like if you're analyzing a deal, if you're looking for like what's the rate you're looking to get a return on, and how do you determine that rate?
Yeah, well, I think it gets back to the earlier part of this discussion about what is worth what to you. So if a business will deliver all kinds of lifestyle perks and things that you find are interesting, then maybe you're going to be willing to accept a lower sort of rate of return on your investment than otherwise. I think it's important for people to quantify it.
Mhm.
I think that people should actually say, running a business that is seasonal and lets me take my winters off and go south
Mm.
is worth this amount to me. So that when you run into such a business, if the numbers are not lining up properly, you can go back to your notes and say, okay, remember I said that this feature was worth $40,000 to me, right? And see if the math works under that scenario. As far as investing your money to get a rate of return and beating inflation, for example, um, I always look at investing with an eye to risk of loss. I would much rather have my money in a high interest savings account losing ground to inflation than trying to beat inflation, but having an opportunity where I could lose 40% of the money in one day,
Mm.
right? And so that's the kind of thing that colors my thinking. And I'm about to turn 50. And I think that it probably is something I think a lot more about than someone who's in their 20s who potentially has time to catch up. I would say this though, when I was in my 20s, I was far more aggressive in my investing. And I always had this idea that if I messed up, I would have a chance to recover. Uh, and I did mess up and I did have a chance to recover. And from my point of view now, I would say it would have been far wiser for me to be more risk averse in my investing
Interesting.
because my ultimate position at this stage in life would have been far better.
Interesting. Cool. Yeah, thanks for sharing that. Well, as we're winding down, I really enjoyed the book. I do like to ask everyone, this is kind of a fun question, but what's the best and worst personal finance advice you've either heard or received?
Yeah, so the worst personal finance advice I've ever received is people who tell young people to choose their higher education based on their passions. You know,
Okay.
follow, follow your passion and the money will follow or all that kind of stuff. In my opinion, post-secondary education is an investment, and you need to look at what the likely returns are from that investment and consider the opportunity cost of spending 2 or 4 years out of the workforce, gaining that education. So that would probably be the worst piece of financial advice. I think the best piece of financial advice is simply about the personal emergency account. You know,
Okay.
there have been several times in my life where I have literally bailed myself out of a crisis because I have had that emergency account. And so I think it's before anyone invests $1 anywhere, save 6 months of living expenses. And again, put it in that high interest savings account where it's always secure, even if it loses ground to inflation. What that money is an investment in sleep
Okay.
because it'll let you sleep soundly at night, knowing that there isn't any kind of crisis that's going to come along and put you on the street. That even if you lose your income or lose your investments or some crazy thing happens, you will have the options of being able to pause and really think about what you want to do because you can still afford to live for a few months before
Mhm.
the rubber hits the road. Whereas people around you in the same bad scenario, they're going to be panicked, and panic leads to poor decision making.
Awesome. Wise advice. Well, David Barnett, it was great discussing your book with you. I definitely recommend it to people. And where can they go get the book, your other books, and get in touch with you if they want to reach out?
Yeah, sure. So if you type David Barnett small business into any place on the internet, you will likely find me right away. I've got a YouTube channel with over 700 videos. All my books are on Amazon. Come check it out. Watch some of my videos. All the audio of the videos is on a podcast feed as well. Wherever you listen to your podcast, you can find it and check out the material. And yeah, if you're interested in this stuff, I'd be more than happy to have you tune in.
Awesome. Thanks so much, David.
Have a good one, Jack.